from WBRN Radio and riding on the Bostonred Network. Numbers, man, here. This week in economics, the date stamp is the 25th of March, 2020. Very interesting week, and that we are recapping. We will be utilizing the Beige Book, and we also have the U.S. International Transactions, fourth quarter and for the year 2019. What we're attempting to do here is highlight the past and the presence of the global economy and also the U.S. economy. Some of the theories we are putting forth here about the U.S. economy in particular is that the status, and we're using the Beige Book to do this, the status of the economy, and this would be from February of 2020, was not what it was portrayed to be in the popular press, nor in the economic or business press. We're not talking about the academic press or what the Fed has talked about in some of their modeling in some of their papers. At best, the U.S. economy was in a certain sectors of it. Manufacturing was in a recession, had been in a recession. And various other parts were in, if you want to call it, a pre-recession stage and moving very quickly. You had the same thing occurring in Germany, in France, and we'll talk a little bit more about that. It's sort of an up and down. We have what's called a seesaw model at Cranston Analytics, and basically that is what has been happening. As also you have seen with the stock market, the volatility index was up about 80. We normally like to see it at about 18. Now today, the futures market in Asia and in the U.S. are up. There has been a tentative agreement in the Senate between the Democrats and the Republicans there. The total will be around $2 trillion, and that will have, and the Trump administration, but it has to go to the House of Representatives, and we'll see what happens there, and they'll then go to a conference and get the bill out there, and supposedly they'll do that on Wednesday afternoon. Now, many things are incorporated in there. Some come from the old cookie cutter. What we mean by that is in the Depression, 2009, 2008, 2009, there was a lot of money given to the banks and to big business. We had that going on, and with little strings attached. We first had TARP, and the reason that TARP originated, that was under G.W. Bush. That President Bush was told by his advisors the whole ship was about to sink, and that was to stabilize the banks because of what had happened with the loans and with various financial institutions that had literally went into oblivion. And we're thinking of some of those institutions that no longer exist anymore, and they totally disappeared. That was a financial crisis, a little different type of person, and it was handled primarily from the start using monetary policy, quantitative easing, that sort of thing. We see that also in the COVID-19 pandemic, and we'll get to that in just a second here. But nonetheless, we had TARP under President Bush, and then under President Obama, we had not only quantitative easing, which would be with the Fed, that's monetary policy, but fiscal policy from the Congress, where billions of dollars were given to various industries with virtually no oversight or control. And some of these industries did pay it back, but there were no criminal penalties given out to people that were in these industries that were responsible for what had happened. They did receive some fines. You had the banks that were heavily engaged in real estate transactions there, that the officials in them, no one went to jail, and the people were mad about it, and it was exploited. On the Boston Red side, that's our political side, we'll talk more about the politics and what went on with the politics. But let's go forward now to the COVID-19 pandemic. That has been handled up to now by using a monetary policy. The Fed had cut the interest rate to 25 basis points, 0.25 there. And they've also instituted quantitative easing, buying bonds. Now, 2008-2009 depression, they would set a number. There are no numbers this time around. They will buy as many bonds. This is government bonds. They're buying corporate bonds. They're buying various types of bonds. They've opened up the discount window. That is where banks can access capital overnight. A little leery to do that. They've used other methods also to stimulate and keep the flow of cash going. But now the negotiation around this bailout, we'll call it, that the Senate is working on now, more dollars will go to workers than had been envisioned by the administration. More dollars will go to the healthcare workers, healthcare infrastructure, the states. There's a long laundry list. Our next broadcast will talk more about that, strengthening also of what is called in the U.S. unemployment insurance. That has happened in many places now. In the U.K., in France and some other places, workers are receiving 80%. Now, what has happened since 2009 depression, we have more people that are self-employed in the so-called gig economy. We did not have Uber, Lyft, and these various other vehicles. So basically what you have done is you move people from being workers to being workers with no benefits, basically speaking. And that is a big hole. You know, some of the things the government has to immediately take care of. And there are also shortages in medical supplies, very big shortages there. And that is a result of national policy by this administration, and to a less extent other administrations, by not properly funding the healthcare infrastructure. So thus, given the nature of things, things like masks, surgical gowns, etc., are in very short supply. Now, some industries, the automobile industry has now started to convert, as they did in the Second World War, that was in the 40s, to making ventilators and various other things, but they're a month behind. And that's part of the problem right there. They're behind the 8 ball, and now in New York, you have the pandemic is spreading like hotcakes on Boston Street, and a very, very big problem. They're using social distancing. Yes, that's about 2 meters between a person, or 6 feet in the U.S. And at the same time, they are asking people to remain in their homes if they have a home, period. Now, that is the big concentration area in New York City, particularly most of New York State there is in the city. And then we go out to places like Los Angeles, the hard-hit Bay Area, up around San Francisco, that area, and then up to Washington State, Kirtland, Washington, where it started there in Washington State. But you have pockets of it. And also a disagreement between the health authorities, who represent science, and the administration that represents, we have no idea, in terms of getting people back. Now, when you start to debate, do we get the economy going again and risk the lives of people, and start doing an assessment of, for instance, if you lose 1,000 people, it is better to employ 10,000 people. So that is a question. Normally they would be in the epical range of questions, but it is not. You can look at the short-term way, and we're talking about jobs here. And the longer term, if you all of a sudden have people dropping in these factories, etc., then you'll have workers that really will not want to go to work. And that's what happened with GM. GM tried, and some of the automobile companies, to do some social distancing, and now they, from complaints by the UAW, the Automobile Workers Union, and now they have closed those plants. Now some will reopen, but again, those are much smaller plants. The larger plants are closed. In other sectors of the economy that are hiring, the Walmarts of the world, the Amazons, they are delivering various product to people. And the food delivery services, they're delivering obviously food. And in states that are under quarantine or lockdown or whatever you want to call it, people are permitted to buy foodstuffs at the market, and also to get needed drugs at pharmacies are open, and some other businesses that are open, and people drive up to it or they leave the product outside of the business. This week, later this week, I believe it's on Thursday, that we'll have the latest unemployment and redundancy figures. Now, these would just be primary figures. So again, are they outliners? Yes, we'll need to have several weeks of this to look at it, 3 weeks at least, to sort of get some type of consistency in the number of people that have been redundant. You will have people from the Ubers of the world, etc. Now, they are trying to strengthen that, where unemployment is normally only to people that are employed under what is called in the U.S. a W-2 type system, to people that are self-employed. And there's other things such as sick leave. These are all temporary fixes, 2 weeks or 14 days of that, and various other things that the federal government and state government are offering. Will they be adequate? No. Will the $2 trillion bill that's now moving through, will it be adequate? The answer there is no. There will be more. Bernie Sanders has talked about, I think there's probably a family of four, at least $2,000 U.S. to a family per week during the duration of this crisis. And what is happening here, and you've seen it before, that under the theory of what's called modern economics, you go into deficit spending for the future, and that is what's happening here. Let me just go back to one other thing, and we'll go to the Beige book. But what had happened with this administration? This administration used neo-Keynesian type economics that are normally used in a downturn to stimulate an economy that they claimed that was underperforming. In other words, the unemployment rate was around 7.5% or something of that nature, to bring it down for a political purpose. Had nothing to do with economics. So you have a massive $1 trillion tax cut, promising that the corporations would use that money and invest that money in their corporations and their workers. They did not. They instituted regimes of buybacks that boost the price of their stocks, and that gives an artificiality to what was going on the stock exchange, and thus the CEOs were able to make out like bandits. So that was money out of the economy. You had the tariff program of the administration that paralyzed various sectors. The agricultural sector caused problems, and they were forced there to come in with subsidies to farmers, because farmers were part of their political supporters. And at the same time, prices of things imported from China and other places went up, cost more money in this country. Now we're seeing gloves and various medical supplies, and China is the primary provider, costs hospitals more, and the states are having to go out and source this merchandise and pay more money. So in the end, when this crisis is stabilized and is over, and they start to bring workers back there, the economy will, as they say, not be as they're talking about. It will not be a flattening out of the curve, will not be normal times, and hiccups will continue. How far the unemployment rate goes, we don't know. Some of the models out there, not our models, some of the models have predicted as much as the unemployment rate at 20%. Mr. Bullard, who is at the, I believe, St. Louis Fed, has talked about, or was, whatever the situation was, the unemployment rate going up to 30%. Now, in the Great Depression, it was in the 20-something percent, and it lasted for years, literally. But now remember, in 1929, there was not the amount of sophisticated communication, and there were no algorithms, there were no computers. Thus, now you could accelerate that, and that's how we see it. In other words, your unemployment rate could be more than it was in 1929, and of course with big data we'll be able to determine where the holes in the economy literally are. But that does not mean we'll be totally accurate. There will not be accuracy. We'll talk more about that at a later date, because we don't want to spend too much time here, because since people that are working at home are by definition dealing with bandwidth and along internet radio, less downloading. But if you don't get us right away, you can get back to its historic purpose. Let's just quickly look at the beige book here, and this was the one put out in February 2020. It was released March. This is for February 2020. I won't go over all of it, but this is overall activity, expanded modest to moderate rates over the past several weeks, according to the majority of districts. St. Louis and Kansas City district, however, reported no change during the period. Consumer spending generally picked up, but growth was uneven across the nation, including mixed reports from auto sales. Overall growth in tourism was flat. Now it's non-existent. There were indications that the coronavirus was negatively impacting travel and tourism in the U.S. Manufacturing activity expanded in most parts of the country. However, some supply chain delays were reported as a result, again, of the coronavirus. Several districts said that producers feared further disruptions in the coming weeks. Transportation activity is generally flat to slightly aside from some of the mid-Atlantic ports. And we talk about, say, for instance, the port of Los Angeles, very big port there, down 30 or 40%. The last figures we had, notable exceptions were, let's see, most districts, notable exceptions were St. Louis, New York, and Kansas City, where declines were reported. On the whole, residential home sales picked up modestly, and non-residential real estate sales and leasing varied across the district. Agriculture conditions were little changed in the recent weeks. Wages and employment wages increased slightly to a modest pace. Overall, with hiring constrained by a tight labor market, no longer the case. Insufficient labor lowered the growth for many firms. Well, that's now very flat. Several employers changed from temporary to permanent workers. That has been something that's happening quite a bit there, now the furloughed workers. While employment grew across most sectors, manufacturing, retail is just about hosed now. Companies reported lower demand for labor in some districts, wages grew at a moderate pace. Prices. Most districts reported modest growth in selling prices as well as non-labor input prices. Some firms, particularly manufacturing, were optimistic, but phase one, this is back to the trade deal, no longer applies anymore. Oil and gas prices decreased, down now to in the 20s, $25 a bale. Basically speaking, the retail prices were up in much of the country. A totally different situation now. In Boston, the regional economy continues expanding. In the early 2020, majority of manufacturing retailers reported revenue increases from a year earlier. Staffing firms also reported growth that's no longer there. Business contacts continue to mention tight labor market. In New York, we can forget about this one now. Regional economy picked up at a modest pace, and the key here is modest pace. In Philadelphia, on balance, business activity resumed at a modest pace. No longer the case for the current Beige Book period. After last period there, tight labor markets continued. Price increases remain modest. They are up now in St. Louis. We already talked about that. Reports from contacts indicated that overall economic conditions have been mixed and are generally unchanged since the previous report. In Cleveland, activity, that's the 4th district, manufacturing demand held steady, but firms note weak demand because of Boeing 737 MAX production halted. And, of course, COVID-19 concerns in the supply chain. That's in Cleveland. Boeing claimed that by summer, July or something, they could possibly have that airplane back out there. I'm not sure what they're going to do with it. In Minneapolis, economic activity grew again at a modest pace. Favorable snow conditions across much of the district, boosted with winter tourism, with some exceptions. Commercial and residential construction and real estate increased. Agriculture conditions were stable at low levels. In Kansas City, consumer spending slowed slightly. Construction activity held steady there. And while manufacturing activity edged up in February for the first time since last summer, you understand the conditions there. In Richmond, manufacturing activity picked up as it did part of the volume there no longer incoming. And again, we get COVID-19 there, lower imports. This is in Richmond. And retail goods from China in coming months. Also, employment increased, wages continued to rise. We already done Kansas City. We'll go to Texas. Dallas, economic activity spend did modestly. Employment grew a slower to modest pace. Input prices continued to rise while selling prices were mixed. Outlook generally improved, though again, COVID-19 introduced new uncertainty into the business environment. That's in Texas. In Chicago, consumer spending, employment increased modestly. Wages increased modestly there. Farm income prospects deteriorated some. Again, COVID-19. In San Francisco, that district's hard hit by COVID-19. Sales of retail goods increased markedly, and consumer and business activities were up somewhat. Manufacturing contrasts, but activity in the agriculture sector increased slowly. That's San Francisco. We'll leave the Beige Book there, but you can understand that this is what had happened prior to where we are today. The international transactions for quarter and 19. This is from the Bureau of Economic Analysis. Current account deficits, which reflects the combined balance on trade in goods and services, and income inflows between U.S. residents and residents of other countries, narrowed by 15.6 billion, or 12.4%, to 109 billion in Q4 of 2019, according to statistics from the Bureau of Economic Analysis. Revised third quarter deficit was at 125.4 billion. Fourth quarter deficit was at 2% of gross domestic product, down from 2.3% in the third quarter. The 5.6 billion current deficit in the fourth quarter reflected a reduction on goods that were partially offset by an expansion on deficit secondary income. Exports of goods and services too, and income received from foreign residents decreased by 5.1 billion to 936.1 billion in the fourth quarter. Imports of goods and services from and income paid to foreign residents decreased by 20.7 billion to 1.05 trillion there. Trade exports of goods decreased by 2.5 billion to 409.7 billion, led by decrease in food, feed, and beverages, mainly soybeans. Changes in other major categories were offset. Imports of goods decreased by 20.6 billion to 612.5 billion, mainly reflected decrease in consumer goods led by apparel, footwear, household goods, automotive vehicle parts, engines led by trucks, buses, and incidentally transportation. Buses, they're down also. Exports of services increased by 2.8 billion to 213.9 billion, mainly reflecting increase in travel. Well, that has disappeared. Primarily other personal travel and business travel, mostly professional and managerial. Imports of services increased to 2.3 billion. Increased 2.3 billion to 151 billion. Receipt of primary income decreased to 2.8 billion to 278 billion. Payments of primary income decreased 4.2 billion to 210 billion there. Receipts of secondary income decreased 2.5 billion to 34.4 billion. Payments of secondary income increased 1.9 billion to 71.7 billion. Financial assets. This is a fourth quarter increase of U.S. residents' financial assets by 1 billion. Transactions increased direct investment, mainly equity, by 35.2 billion. The portfolio investment assets 18.9 billion, resulting from large and mostly offset transactions in equity securities, and we don't have the latest. Liabilities increased for U.S. by foreign residents of 71.9 billion. Transactions increased direct investments and liabilities, mainly equities, by 43.5 billion. Financial derivatives, net transaction financial derivatives were a negative 0.9 billion in the fourth quarter, affecting borrowing there. And for 2019, goods balance, the current account balance was negative 24.1. That's the primary, and then it was 25.4, the revised estimate. Goods preliminary estimate, 21. Start over here. 2.196. That was the preliminary, and the revised was a negative 220.9. Service balance. Primary was preliminary. Wow, on the politics side here, 62.2, and it was revised to 62.5. And now we get to a primary income balance at 68.7. That was the estimate, and the revised was 65.9. And secondary income negative 35.5, and it revised to negative 32.9. This is for the third quarter of 2019, and the final the revised estimate negative 76.4, and the current U.S. current account deficit widened to 7.4, and it will increase much more because of the buying of mass, etc. 0.5% to 498.4 billion. This is in 2019. The deficit was at 2.3% of current dollar GDP, down from 2.4% in 2018. 7.4 billion, a widening of current account deficit in 2019 mainly reflects expanded deficit on secondary income, a reduced surplus on services are offset by a reduced deficit on goods. Export of goods and services, the income received from foreign residents increased by 28.3 billion to 3.76 trillion. That was in 2019. Imports of goods and services from and income paid to foreign residents increased by 35.6 billion to 4.26 trillion. Exports of goods decreased 21.5 to 1.65 trillion, mainly reflecting a decrease in capital goods, mostly civilian aircraft. Imports of goods decreased by 42.6 billion to 2.52 trillion, mainly reflecting decrease in industrial supplies, materials, mostly petroleum. You're going to see more of that now. Exports of services increased by 18.2 billion to 845.2 billion. Import of services increased 28.1 billion, 595.4 billion, reflecting increase in all major categories. Led, well, you forget that, travel. This was in 2019. Receipts of primary income increased by 28.9 billion to 1.12 trillion. Payments of primary income 35.9 billion to 866.1 billion. Increase in both receipts and payment there. And receipts of secondary income decreased by 7.4 billion to 142.8 billion, mainly reflecting a decrease in private transfer and mostly insurance-related transactions. Secondary income increased by 14.3 to 281.7 billion. So that is it, and that was 2019. Net account transactions were 395.9 billion in 2019, reflecting net U.S. borrowing from foreign residents. The transactions in 2019, residents' foreign assets of 426.9 transactions increased, mainly equity by 197.7 billion. As portfolio investment assets resulting from large and mostly offset transaction equity securities and debt by 35.9, mostly bank deposits by 188.7 billion, and reserve assets by 4.7 billion. Transact 2019 by 4 billion, and equity by 310.8 billion. And debt securities of 331.6 billion. Other liabilities, mostly bank deposits, 242 billion. So this is it. The next report will be on June the 9th. But we'll see. We'll go to some of these very, very quick. These are from our market people here, PCIs. I'm not first, but it doesn't matter. This is the Flash UK composite PMI signals a record slump in business activity and amidst emergency health measures to halt. This was released on the Outlook Index survey March at 37.1, a record low. It was in February. It was at 53. You can understand what's going on here. The UK Service Business Activity Index for March at 37.7. A record low, it was 53.2. The manufacturing 3, that is a 90. It was 52. Above 52 is out there. The UK flash manufacturing PMI in March. Let's see if we get that. Yeah. At 48 there, 3-month low was 51.7. The March data highlights the COVID-19 outbreak dealt the UK economy a more severe blow than any time since figures were first available 20 years ago. The combined monthly decline in output across manufacturing services exceeds that even seen the height of the global financial crisis. They're talking about depression. With the IHS market chips flash composite falling almost 16 points since February 2020 at 37.1, March down from 53. A rapid decline in business activity across the service economy led the overall downturn in March. The index is at 35.7 as emergency public measures to halt COVID-19. And moreover, the latest figures that were compiled in advance of the U.S. government's decision to order pubs, restaurants, and leisure down. Manufacturing production also dropped sharply. And this is from Dr. Chris Williamson. The survey highlights how COVID-19 outbreak has already dealt the UK economy an initial blow even greater than is seen in any height of the global financial crisis. They're talking about the depression there, with additional measures to contain the spread of the virus set to further paralyze large parts of the economy as businesses close and potential lockdowns. Recession of some scale we have not seen in modern history is looking increasingly likely. Historic comparisons indicate that the March survey reading consistent with GDP falling at a quarter rate of 1.5 to 2% decline, which is sufficiently large enough to push the economy into contraction in Q1. However, this decline will likely be the tip there. Any growth was confined to small pockets of the economy, such as food, pharmaceutical industry, and healthcare. Demand elsewhere has collapsed both for goods and services, period. And this is from Duncan Block. He's with Flips. Just as the economy begins to strengthen at the beginning of the year, the shock of this deepening global crisis has abyss, with the overall downturn in manufacturing services for more than 2 decades. The sector recorded its worst drop in activity since 1990. This is the service sector, 96, when the survey began. New orders also has rapid realization of the significance of COVID-19. And this is the COVID-19 story. Let's go to it. And this is the present. We went from the beige book on. This is Japan's economy downturn deepens drastically in March. The flash output index, March, is at 35.8. It was at 47 in February. The service activity index at 32.7. It was 46 February. And the manufacturing is at 44, not as bad, from 47.8. Today sees the latest release of the odd Java bank flash composite, published on a monthly basis here. And this is John Hayes. He's an economist. At market prospects for the Japanese economy this year weren't particularly good before and this has been a concurring theme we've been out here talking about, the outbreak of COVID-19 with the country's economic potential dwindling due to an aging workforce and a declining population. Latest PMI data shows that the Japanese economy slipped into an aggressive downturn in March that was primarily led by the service sector, plummeting tourism, events cancellation, supply chain disruptions leading to fast drop in private sector output since the tsunami. That was in 2011. In fact, the decline in service activity was the sharpest we recorded since the survey began. That was in 2007. In contrast to other parts of Asia, U.S. and Europe, Japan, for the time of this writing, has not issued a public lockdown. Of course, the Olympics in Japan have been canceled, period. Let's go to our last piece. Now, this is Eurozone PCI, and again, the title here, COVID-19 outbreak leads to the largest collapse in business activity ever recorded. Now, the Eurozone flash index is at 31.4. That was down from 51.6 in February. It's the lowest since July of 1998. The flash Eurozone service PMI index at 28.4. It was 52.6 in February. Lowest recorded again since 1998. The flash Eurozone manufacturing, a little better here at 39.5. And it was 48.7 in February. And the flash, that was output. The flash manufacturing PMI at 44.8, and it's 49.2 in February. It's 92-month low. Eurozone suffered an unprecedented collapse in business activity in March as the COVID-19 outbreak intensified. at 31.4 in March. The flash collapsed from 51 there. Then we say any more. And these are more real-time. French business activity contrasted the sharpest rate in 22 years. The PMI slid sliding from 52 in February to 30.2. A record decline in the service sector was accompanied by a sharp drop in family production. In Germany, meanwhile, plunged from 50.7 to 37.2, signaling a weak downturn. A weaker downturn than France. But still, since 2009, Germany saw a record deterioration of the service center activity and a drop there. The rest of the Eurozone reported an even steeper decline than seen in France and Germany, which are the largest. This again from Dr. Williamson here. Business activity across the Eurozone collapsed in March to the far extent than has been ever seen at the height of the global financial crisis. That's the Depression. Steep, not the Great Depression, but the Depression we're seeing in France. Germany now, you're also going to see it in Italy. We don't have it up here. The March PMI is indicative of GDP slumps at a quarterly rate of around 2%. And clearly, the scope for the downturn intensifies further, even as draconian policies to intensify further, even implementation coming months. Demand for goods and services have fallen dramatically. Employment is already falling at a rate not seen since 2009. It broadens. There's no doubt about that. And we'll see this in further broadcasts of how bad things are. So in general, as we sum up the activity here, what we are seeing right is unprecedented, because in the 1929 Great Recession, we had a recession that was caused by tariffs again, reminiscent of what's happening right now. But those tariffs at the time, it was a one event. Banks, everything collapsed. The unemployment rate moving around 30%, and more in other parts of the country. Obviously, we're talking about the U.S. now, but we did not have a global pandemic pushing it. So what we see basically now is like pushing a car on the highway, and the economic downturn that was already coming on because of the tariffs in the U.S. by the Trump administration, demand and various other things in the UK by Brexit. We haven't talked about Brexit, but COVID-19 has taken that over. The UK was in for a decline anyway, as it left the EU. And now we have in Italy, the COVID-19 has destroyed the Italian economy, and then on to Spain and into France. So in other words, the whole Eurozone. Then we have the epicenter in the U.S. now has moved to New York, the financial capital in the U.S., one of the very large cities in the U.S., and on the West Coast in the Silicon Valley, San Francisco, not as bad there, obviously, and down to Los Angeles. And now we're looking to see what's going to happen in Florida, because people from New York go constantly to Florida. Now they're on a 14-day isolation episode. And in states that have very poor healthcare systems, we're thinking of Texas here, in New Orleans, of course, the port there in New Orleans, the casinos are closed down. Casinos also closed in Las Vegas, Nevada. So we see a lot of closures out there. There was a big debate with the criminal workers on Medicare for All, that they wanted their insurance. Now they'll get a chance to use it. However, though, they are furloughed. They will be back at a coming date there. The national administration through DJ Trump announced he'd like to get things back by mid-April, around Easter holiday season. That will not happen, because in New York, we're looking for the last week of March as a transition to a peak. Now, one of the things, and we've been modeling COVID-19 also, one of the things to look at is peak and how peak is handled. Now in Italy, they've had peaks, and but they're still having deaths there. I think they've peaked. from other models. Say that they have some peak there, and will the isolation work? Social isolation or distancing will work to a certain extent if you start the problem. But now, if you wait until people have moved all over the place, we had an outbreak on the Roosevelt, which is a very large American naval ship, about 5,000 people there. 3 sailors were airlifted out. Now, how many other people have it there, we don't know at this point in time. And they had been on a furlough to a port in Vietnam. Now, Vietnam does not have a large COVID-19 population. So there's a lot of work to be done here. Statistical work. There are all kinds of models out here. Some indicate that in the U.S. up to 40% of the people could be infected. We feel that's a high number at this point in time. However, if you look at pandemic, Spanish flu, my grandparents lived through that. They survived it. But worldwide, they don't really know the number. Anywhere from 50 to 100 million people succumbed. In Seattle alone, there were roughly about 1,600 deaths. So again, it's hard to say. Medical equipment is being amassed. Supply chains are being restruck. And more surgical masks, etc. So there is going to be some trade deficit there. We see that happening, no doubt. The healthcare sector, providing healthcare workers are still around to enjoy it, will be expanded. The social safety net in places like the U.S. has to be looked at very seriously. Now, this is on the political side, or monetary side of what is going on here. The Federal Reserve, though, now is not only buying bonds, they're buying corporate, they're buying all kinds of things, and they're also talking about making loans or guaranteeing loans for consumers. Now, some states are aiding small businesses, or making, say, $2,500 to $30,000 as a tie over, and how they're going to define if the business was a vital business or not. It's very difficult to say, but we'll look to all of this. This is Numbers Man in the Jerry Pippin broadcast booth on the 25th of March 2020, and we'll talk to you soon. For those in business, well, make it as productive as you can, and for the consumer, obviously you're at home, so isolate, test,